From persistent inflation to turmoil in the banking sector and throughout a nervous financial market, watching its every word. The Fed has been between a rock and a hard place for some time now. So does today's inflation reading move the dial on policy, or are we still some way from a clear picture of the road ahead? Here to discuss this and much more, Gary Cohn, IBM Vice Chairman and former Director of the National Economic Council. Gary, great to have you here in studio with us.
Thanks for having me.
Absolutely. All right, so help us kind of parse through that first question there. Does this inflation reading today really change the equation, the calculus for the Fed?
I'm not sure it does. I mean, we came in sort of right on where everyone had predicted we would. We came in at 5% overall inflation, about down a tenth from where people thought we would. But if you look at core, which is, I think, where the Fed spends more of their time, core is still relatively sticky. We're stuck at 5.6%. You take out food and energy, which we know are very volatile components. And we know that energy has moved a lot since the last month reading. We've seen the oil prices have gone up quite dramatically. So I think the Fed is going to sit here and sort of contemplate what they have done. We know that the chairman has talked a little bit about the lag effects and the cumulative effects of monetary policy. He's weighing that on one hand. Clearly, what are the long-term effects of what we have done? On the other hand, he's looking at the banks. He's looking at the mark-to-market losses that banks have by buying the most secure asset they can buy, which is a U.S. Treasury bill, which is a zero risk-weighted asset. It's what they encourage banks to buy. And he's trying to weigh those two countervailing forces. Overall, their mandate is to get to 2% inflation. So at 5%, we're still 300 basis points above the overall mandate. And I think the chair is going to have to weigh those issues. We're going to get some more information this afternoon. We'll get the Fed minutes this afternoon, so we'll see what they were thinking during the last Fed meeting. Now, the last Fed meeting, people will probably discount those minutes because we've had an awful lot of disruption and instability since the last Fed meetings. Sure. But it will be important to see what people were thinking. It will be important to see what the discussion was a month ago.
And so the market's still pricing in this quarter-point rate hike in early May. What does that mean for the economy once that happens, right? And I mean, does it feels like we're in a little bit of a holding pattern now, especially as we're waiting for earnings? I think we're in this, I don't know if it's a holding pattern or at the end of the cycle pattern. It feels to me like we're at the end of the cycle pattern. The debate is 25 basis points, pause, pivot, or are we getting ready to pause? Is the 25 basis points not going to happen? I think I'm more or less in the 25 basis point camp now because, I think with the 5% reading here, banks somewhat stabilizing. We've seen a lot of movements in deposit flows, and we have to sort of evaluate that because, one of the things that the chairman said during the last press conference, and I think this is very important, is that lending conditions in the banking community are changing quite rapidly. We've seen a lot of deposits move around the system. We've seen deposits move from small regional banks to larger banks, and then we've seen deposits move out of larger banks into money markets and treasury funds. So there's less money in the system to be lent out. Once banks have to hold their excess reserves, they can lend the remaining balances. But the remaining balances today at banks are relatively low. So the banks themselves are contracting the economy. The Federal Reserve Board understands that. I think they're trying to understand what the magnitude of that is. I've seen reports where the magnitude of that is equal to somewhere between 25 and 75 basis points of increased interest rates. So we have to understand where that is. So I think we're sort of at the end of this cycle. And that's why we're in this sort of holding pattern. We're holding to see what the Fed's going to say, what Powell's going to say now that we have this banking, the sort of banking data behind us, that we've seen reserves come out of the system, that we've seen this flight to money markets, we've seen a flight to treasuries. How do they evaluate the tighter lending conditions, and how does that influence their decisions? That's why I think even when you see a more positive inflationary report today, you didn't really see a large interest rate move. You didn't see the moves that we might expect.
And so, as we're waiting for what those minutes reveal about how the Fed members and the Federal Open Market Committee members are speaking, you have a line of communication that's into a lot of bank CEOs that many people don't have. Of the conversations that you still have with those profiles, people who are running the largest banks here in the U.S., what's going down in the DMs? What are they telling you? What are the text threads like right now, or the conversations especially around their sentiment in the current economic environment that we're finding ourselves in?
Well, I think everyone's concerned about liquidity. Everyone's concerned about lending conditions. Everyone's concerned about the real estate market. We hear everyone talking about the commercial real estate market and all of the loan maturities that are going to happen over the remainder of the year. Mm-hmm. A lot of that commercial real estate lending has been done in the, I would say, mid-tier banks. So the bigger banks are trying to figure out what effects that's going to have. The mid-tier banks are trying to figure out what effects that's going to have. The loan to values are going to change quite dramatically. We see a lot of empty square footage. We see the prices coming down. So there's an evaluation of what's going to go on in asset quality. There's an evaluation going on in liquidity and liquidity standards. I think people are concerned, will there be a overstep or a misstep in regulation into the banks? So banks are always concerned about additional regulatory costs, additional regulatory hurdles. And what does that mean? So holding more liquidity and holding more capital is always a good prophylactic against another regulatory move. Mm-hmm. So I would characterize banks right now in a relatively conservative mode. You're right, we will see bank earnings later this week. But remember, that's a backwards looking phenomenon. And we are, and I think we say this a lot, we're in a very volatile time. It's a lot less predictive of this quarter, what happened last quarter, because of the amount of money that we've seen move around the system. Move from small banks to medium banks to large banks to money markets and treasuries. We really have to sort of reevaluate what banks are going to look like and what they're going to do going forward.
So I have sort of two follow-up questions to that. Those concerns about liquidity that you talked about as we see the deposits flowing from the small banks to large banks into money market funds, et cetera. Are those liquidity concerns justified, do you think? In other words, are we going to see some more blow-ups among the banks? It feels calm right now, like it has been revealed, but has it?
So I remind people that every year we lose banks out of the U.S. banking system. So, since Dodd-Frank, I think since the Dodd-Frank legislation after 2008, we've lost over 10% in the banks of the United States. So we've had this slow grinding whittling away of banks in the United States. I think we're more acutely aware of what's going on now because we've seen larger banks, much larger banks, run into financial trouble, and we've seen larger banks go out of business. I don't think we have seen the end of this banking situation. I won't call it a crisis because I don't feel like we're in a crisis, but we're in a situation where banks were sort of flooded with deposits during COVID, flooded with deposits during the crisis. A lot of it was government stimulation. A lot of it was people just had money coming in. There was no way for people to spend money because there was no consumptive ability except for things that could be delivered to your house or you could buy at the grocery store. So your ability to consume money was fairly low, which meant there was no loan demand for banks. So banks were seeing deposits come in on one side, and they were seeing nothing going out on the asset side. They weren't able to lend money to people because people didn't need to borrow money. So all of a sudden they were in this position where they had huge excess reserves. And the natural thing to do was to go out and buy some interest-bearing, low-risk asset. The most unique low-risk asset in the United States is a U.S. Treasury. Then we saw this massive move in interest rates, close to 500 basis points. So it's virtually impossible that banks don't have big mark-to-market losses on their balance sheet. We know that they all have big mark-to-market losses. Now, some of the bigger banks run those through their year-end stress test calculations. Some of the smaller banks don't, but we're getting more and more transparency to what banks' tier one capital looks like on a mark-to-market basis with their hedges. And we're not through to the other side of this. So nothing has changed in the banking sector from where we were 6 weeks ago, except we understand what happened at Silicon Valley Bank. We understand what happened at Signature Bank. We understand the mark-to-market losses in the available for sale and the hold-to-maturity buckets.
The other thing you mentioned is the best prophylactic against regulation is increased provisioning, right? Increased reserves at the banks. They're about to report. We're probably going to hear. There's been some reporting around the amounts that we might hear from the banks. Should we be alarmed or reassured by that money that they're putting aside?
I think all the banks are going to talk about the excess liquidity they have. I think many of the banks will talk about their insured to uninsured deposit ratio. I think they'll talk about their mark-to-market losses that are disclosed and non-disclosed in their hedging books and what the asset side of their balance sheet looks like. I think banks will go out of their way to give you more disclosure on what their portfolio looks like at this time, because I do think that is a good prophylactic. If you're trying to fight the knee-jerk reaction in Washington, which is just something bad happened, let's go regulate, show that the U.S. banking system as a whole is very, very well managed. It went into this whole scenario very well capitalized. And I think the bigger banks are going to go out of their way to show you how well capitalized they are.
You had previously, back in 2017, I believe, called the Dodd-Frank do-over a win for banks. But there was some deregulation that took place with that Dodd-Frank do-over as well. Did that reinsert unnecessary risk into the system that now caused some of the very crisis that we're seeing right now?
Early after Dodd-Frank came out, I did say, look, you had put a moat around the largest banks in the United States. You had put the regulatory burden so high on those banks that it was virtually impossible for any bank ever to cross into that moat. So you were almost protecting the largest banks in the United States. And the too big to fail was almost too big to compete with, because the regulatory costs that they were going to have, no other bank would want to get to the other side and have all those additional regulatory costs. And so those big banks became more and more secure. And we saw that. We saw the flight to quality a few weeks ago was into the biggest banks in the United States, because no one feared the biggest banks in the United States because they are so big. You know, we in the United States have a very robust regulatory process at all levels, at all size banks. All size banks go through a robust regulatory system, whether it's a state bank or a federal bank. The question to me is, once they're going through the regulatory process, how vigilant are those regulators? So the problems at Silicon Valley Bank were really well identified. The bank was given, notice in a way that they had an interest rate problem, whether it was a matter needing immediate attention or a matter needing attention. The issue to me was there follow-up from the regulators on making sure that that matter was taken care of? I can tell you from great experience that if you were regulated by the New York Fed, they would not forget to follow up every day. If they had sent you a letter like that saying, hey, look, you've got a fundamental problem in your hedging book, you've got a mismatch in your asset liability, they would be talking to you every day about managing that. The question was the San Francisco Fed as diligent and rigorous as the New York Fed? We don't know. It may turn out they are, and it may turn out that the Silicon Valley Bank just didn't move quickly enough to deal with their problem.
I want to switch gears and talk about what you're doing now at IBM. Maybe it's a relief now to not be in the banking business while all this is going on. Not that the tech business is calm and quiet and unturmoiled right now. So how are you thinking about tech growth as we go through the year? We talked a little bit about this back in January at Davos, amidst this tech environment that is a little bit tough right now.
Although if you look at the overall tech world, Q1 in the tech world, I think it surprised everyone to the upside. We saw this rotation out of the energy world and out of some of the industrial companies back into tech. Tech probably was one of the leading sectors in Q1.
Yes, unless people are setting themselves up for disappointment this earnings season, hopefully not.
They may be, but I think what you saw in the tech world as a whole, let me talk very holistically and very generally. The tech world as a whole, I think, understood that we were going into a tougher economic situation. Many of the companies got down to the fundamental basics of how they ran their companies. Most of the tech companies, Silicon Valley related especially, really grew significantly during the crisis, during the pandemic. They were the ones doing massive hiring. They were growing. They were growing exponentially, some of them. I think as we got into 2023, many of them said, hey, look, we just can't grow at a headcount. We just can't grow at all costs. We have to right-size our business. We have to right-size our footprint. We're going to have to get ourselves into a more competitive posture. And that may mean making tough decisions and downsizing on headcounts. And we've seen a lot of that. We've seen a lot more layoffs coming out of the technology sector as a whole than almost any other sector. So we've seen the technology sector taking pretty aggressive actions in right-sizing their companies, trying to figure out where the economy is going, where the demand's going, how they're going to continue to grow, how they're going to continue to be good shepherds of capitals for their shareholders. And the market has responded by rewarding those stocks because management has gotten in front of the newfound emphasis on making sure shareholder returns are adequate. So, technology has been a good place to be so far in 2023. I still feel like it is a good place to go. We are a technology-driven country. We continue to find new areas. The whole AI machine learning space. It's a space that people in the industry have known about for a decade plus, but it's now becoming a very retail piece of the equation. So we continue to see new routes of evolution, new routes of expansion in the whole technology world. And I think the biggest companies at the end of the day will be the winners in this space. As you've seen, the biggest companies, if they weren't the inventors of some of these products, they clearly had the balance sheet and the capital to go out and buy or get invested in some of the newest products that exist. So look, my view is the technology business in the United States is continuing to grow. It's a robust place to be, and is a big differentiator to the U.S. capital markets and the U.S. economy.
So I know you want to follow up on AI, but first I want to ask you a little bit more about the sort of expense rationalization and a little bit of shrinking. IBM announced some job cuts earlier in the year as well. Not a huge number relative to the size of the company and relative to what we've heard from others. Where are we in that cycle? Could there be more cuts at IBM, for example, do you think?
So I'm not going to talk specifically about IBM. We're in an earnings blackout. So that's why I'm going to talk generally about the industry. I think the industry right now understands that there's a lot of competition and that making sure that shareholders are getting an adequate return on capital and that management and boards are being good stewards for capital is very important. Where when you were in 40, 50, 60% growth modes, you had the ability to hire and try and expand and grow your business. Since growth has slowed down across all industries, so all industries means your clients are also slowing down as well. You have to manage your expense model more diligently and more rigorously. And I think that you're seeing that across all of the technology industry.
Artificial intelligence is having perhaps its baggy jeans moment right now. They were popular back in the early 2000s and now once again popular. So now we think about
at least you remember it was popular in the early 2000s.
Yes,
Many people think it's brand new.
Right, exactly.
I remember Watson on Jeopardy. So
precisely.
There you go.
Right. And so all of this considered, for any company that has annexed anything generative AI to their future announcements, to how they're embedding it within technology solutions, it is lighter fluid to their stock price, to how much eyeballs they get. All that to say, IBM's been doing that, right, for a while. And so now when you think about generative AI or artificial intelligence as a whole, as an economic input, what do you think about in terms of what that means for productivity, what that means for the employment situation, and how the broader economy may shift as a result of that?
Look, we have seen very few things in our generation that have really changed worker productivity. What's in front of you, the laptop or the computer, was the last major shift in worker productivity. AI and machine learning could be the next big leg in worker productivity. What machines can do with humans can make human capital so much better at what they do and can allow them to move faster. And it can allow people within the organization to be much more efficient at what they do. So to me, it looks like it could be a major productivity gain in allowing machine learning and AI to be part of an organization. Now, it's not going to happen overnight. Just like the laptop, the first version of the laptop computer didn't have a instantaneous effect, but as it got better and better and faster and more software was written, it became a really productivity enhancing tool. Machine learning AI, we think, will have enormous impact on the productivity of the U.S. labor force, and it will allow people with different skill sets to be much more effective at what they do.
Does that mean displacement, or does that mean in tandem from your perspective?
I would say in tandem.
In tandem, okay.
Well, that's a good place to
Yes.
end it, I think, on an optimistic note. Gary, thank you so much for coming in. Great to see you in person and not in a freezing outdoor Swiss hillside. Gary Cohn, Vice Chair of IBM, thank you.
Thanks for having me.